In 2025, gold ETFs absorbed $89 billion. Not over a decade, not over a cycle. In one calendar year, holdings surged to 4,025 tons. That is more metal than many nations have ever owned, sitting inside products designed for speed, convenience, and instant liquidity. And while that river of paper demand was pouring in, another quieter river was moving in the opposite direction. Physical demand that refused to back down, and vault behavior that hinted the real story wasn't price. Here's the part that breaks normal expectations. The crowd believes gold is simple. Fear rises, gold rises, calm returns, gold falls. But the data has been telling a stranger story. In just the span of weeks, the market shifted from dismissing gold as yesterday's trade to treating it like a crowded theater with one narrow exit. And when that happens, what matters isn't the headline price. What matters is who owns the claim, who controls the inventory, and which form of gold the system trusts when stress arrives. They said this kind of dislocation couldn't happen anymore. In the modern era, with transparent markets and instant pricing, the paper and the physical should stay stitched together. But the stitching is exactly what's fraying. Because gold is one of the few assets on Earth that exists simultaneously as a global price and as a physical object that must be moved, stored, insured, and delivered. The moment those two realities stop agreeing, the market doesn't resolve gently. It resolves suddenly, and institutions already know. They always do, not because of conspiracies, because their balance sheets touch the plumbing. They see funding conditions, collateral preferences, and settlement stress long before it becomes a trending topic. The public gets the story after it's safe to tell. The data shows the story while it's still dangerous. What I'm about to lay out isn't opinion, it's pattern. It's the repeated playbook of paper flows, physical flows, and institutional positioning that has shown up before major inflection points in gold. And if you can recognize it, you stop looking at gold like a commodity that wiggles. You start seeing it as a barometer for trust in the financial system. Welcome to Signal and Bullion, where we decode what matters before it becomes the headline everyone pretends they saw coming. If you like analysis that follows the money instead of the noise, stick around. And tell me where you're watching from, because this is a global market, and the most important clues often show up first on one side of the world and only later on the other. Now, the event. In late January 2026, the flow data out of Asia looked like a rupture. $1 billion in a single month, $9 billion. At the same time, the conversation in other corners of the market shifted toward warning signs, not because gold was weak, but because it was strong. That is a tell. When an asset rallies for years, skepticism dominates. The public arrives at the party right when the music gets loud enough to hear from outside. Step back 1 month before that January burst, and you can see the acceleration. December 2025 alone brought in about $10 billion of global gold ETF inflows, extending a 7-month stretch of positive flows. In other words, the shift wasn't a one-day headline spike. It was a sustained behavioral change, the kind that pulls gold out of the nobody cares corner and into the core macro allocation conversation. When flows stay positive that long, desks begin to treat them as persistent, not random, and they start building positioning and hedges around the assumption that more is coming. That's how markets become one-way streets without anyone announcing it. That question matters, because the ETF creation process is both simple and demanding. Authorized participants deliver bars that meet strict standards, often in the London good delivery format, into approved vaults. In return, they receive ETF shares they can sell into the market. The mechanism links paper demand to physical inventory, but it does so through a narrow doorway. Bars must be the right size, the right purity, the right chain of custody, and in the right place. If demand rises in one region while the available bars are concentrated elsewhere, the market can still work on paper, but the cost of keeping it working rises. Those costs don't always show up as a higher spot price first. Sometimes they show up as delays, premiums, and unusual movements of inventory between vaulting centers. And time is exactly what paper markets don't price well. Futures and ETFs price immediacy. They price the belief that conversion between claims and metal is frictionless. Physical markets price frictions. They price logistics, delivery windows, local premiums, and the reality that some holders simply won't part with metal at any reasonable spread when they're buying it for trust, not for a trade. That's why you can see a strong spot price and still hear stories of tight products at the retail level. The spot market is not the shelf. The shelf is where frictions become visible. This is also where the East versus West lens becomes useful without turning it into a cliche. Western financial markets are optimized for trading claims. Eastern demand, historically, has been more comfortable holding the object. When Western flows surge into ETFs, the market can feel liquid because shares are liquid. When Eastern demand rises for physical bars, the market can feel tight because bars are finite. When both rise together, the system can function, but it starts to reveal its stress points. because the same ounce can't be in two places at once, and the incentives to move it depend on spreads, trust, and balance sheet capacity. Meanwhile, physical demand didn't fade into the background. Total gold demand in 2025 exceeded 5,000 tons for the first time, and the total value of that demand hit $555 billion. That's not a boutique allocation. That is system-scale behavior. Central banks still bought 863 tons in 2025, not the kind of number you see when gold is merely a speculative trade. That is the kind of number you see when institutions treat gold as a reserve asset, a form of collateral, or a quiet vote on long-term currency credibility. So the central mystery is this: if paper exposure is flooding in and official sector demand stays elevated, why does the market keep displaying symptoms of mistrust between paper and physical? Why do we keep seeing the narrative split into two worlds? A world where gold is a chart, and a world where gold is a thing that must be sourced. To understand what's happening now, you have to understand what happened before, when the same fracture appeared in a more dramatic form. Go back to 2013, 8 tons. The price fell hard. Headlines declared the end of gold, and financial investors dumped paper exposure. 1 tons. Paper was fleeing while hands were reaching for metal. The market wasn't unified. It was bifurcated. And what followed wasn't a clean reversal. It was a shift in where gold lived and who controlled it. Physical demand rising during paper liquidation meant metal moved. It changed vault geography, it changed liquidity, it changed who could source what, and it changed the long-term behavior of premiums and delivery stress whenever the system tightened. That pattern didn't start in 2013, it echoes earlier. In 1980, gold spiked during an inflation shock and crisis of confidence. The price move became the story, but the underlying driver was a collapse in trust, in currency purchasing power, in policy control, and future stability. In 1999 and 2001, you saw another version: central bank policy and official sector decisions altering the perception of gold's role, and once again the market learning that gold's price is not just a chart. It's a referendum on credibility. Then, in 2008 and 2009, gold didn't merely rise because people were scared. It rose because the world learned something about credit. The crisis wasn't just equities falling, it was collateral failing. It was the discovery that even safe claims could be questioned. Gold in that period wasn't a bet. It was an alternative to believing every link in the credit chain would hold. Now look at the structure of the pattern, because it repeats. First, stress builds in the system, often invisible. Second, paper flows swing hard either out or in, depending on the phase. Third, physical demand behaves differently from paper demand, either resisting the selling or refusing to loosen despite the rally. Fourth, institutions adjust quietly: central banks, large funds, bullion banks, refiners, exchanges. Fifth, the market resolves the tension through volatility, repricing, or a shift in where the metal sits. In 2025 into early 2026, the paper side is shouting allocate, while the physical side is still firm. That creates a different kind of tension, a scenario where paper demand adds pressure on an already tight physical narrative. And that's when the questions get sharper. The claim or the metal? To answer that, you have to look at the players. Start with the ETF ecosystem. The largest gold ETFs sit on enormous pools of metal, stored in major vaulting centers with authorized participants that can create or redeem shares by delivering or receiving bars. That mechanism is elegant in calm markets. It keeps the ETF price close to the underlying, but it depends on smooth inventory movement, predictable funding, and willing intermediaries. Then consider central banks. When a central bank buys 863 tons in a year, that isn't a trade with a stop loss. That's a structural decision. It is a slow, deliberate transfer of reserves into an asset outside another country's liability. And when that buying remains elevated for multiple years, it changes the baseline. It means a meaningful portion of annual mine supply and recycled supply is being absorbed by entities that rarely sell quickly. Add the third player, retail physical demand. Bars and coins are not traded by algorithms. They are bought, stored, and often held through volatility. That makes physical demand sticky. It doesn't respond to price like a futures contract does. And that stickiness becomes crucial when paper markets attempt to absorb or release risk in a hurry. Now add the fourth player, the futures and derivatives complex. Futures markets are where price discovery often happens at the margin, and where leverage can amplify moves. In those markets, a large position can be created with a fraction of the full value posted as margin. That leverage is not inherently bad. It provides liquidity. But it also means that when conditions change, when margins rise, when volatility spikes, when funding tightens, positions can be forced to unwind regardless of fundamental views. The fifth player is the vault network, the custodians, the refiners, the logistics channels, the places where metal is weighed, assayed, and stored. This is the physical nervous system. It is slow compared to a click, but it is decisive because in the end, physical settlement is not a belief. It is a process with limits. When you line up these players, you begin to see why gold can break pattern. The paper side can expand exposure instantly, but the physical side can't conjure metal instantly. If paper demand surges while physical demand remains firm, the system leans on intermediaries. It leans on vault inventories, on leasing, on swaps, on the willingness of holders to part with metal. If that willingness declines, dislocations appear. That's the dislocation we're talking about. One set of signals says the market is embracing gold through financial products. Another set says the market is still treating gold as a physical asset whose availability matters. When those two signals diverge, prices can still rise, but the character of the market changes. Liquidity looks abundant until it isn't. Spreads stay tight until they don't. Premiums remain normal until a rush for a specific form of metal forces them wider. The proof sits in the numbers. Start with the ETF data, $89 billion of inflows in 2025, taking AUM to $559 billion and holdings to 4,025 tons. That is an 801 ton increase in holdings in a single year. Then look at the demand side. Total demand above 5,000 tons, valued at $555 billion. Then consider central bank demand, 863 tons. Those are not marginal figures. They are the footprint of institutions and investors treating gold as a serious component of the global reserve and risk landscape. 1 tons. That year taught the market a lesson. The paper and physical can diverge violently, and when they do, the price can move in ways that seem irrational if you only watch one side. The contradiction today is subtler but more dangerous, because in 2013, paper was selling, physical was buying, and the price fell. That makes sense to a casual observer. Selling pressure wins. Today, paper is buying, physical is also firm, and the price is strong. That feels comforting. It feels like alignment. But the alignment is not complete, because paper exposure can be created faster than physical supply can be mobilized. In other words, the same force pushing the price up can also be building a vulnerability underneath it. This is where it gets interesting. When flows into ETFs surge, the system must source bars that meet specific standards in specific locations through specific custodians. If those bars are plentiful, the mechanism works cleanly. If those bars are tight, the system can still function, but it starts to rely on substitutions, sourcing from different vaults, shifting inventory between centers, and using swaps or leases to bridge timing gaps. None of that is sinister. It's normal market plumbing. But it becomes critical when conditions tighten because plumbing that works in normal pressure can fail when pressure spikes. The most important insight is that gold is not one market. It's a set of linked markets: spot, futures, ETFs, OTC, jewelry, industrial demand, central bank reserves, bars, coins. They are tied by arbitrage, but arbitrage depends on balance sheet capacity and confidence in settlement. When those constraints tighten, the links weaken, and the same ounce can command different prices depending on where it is and how quickly it can be delivered. That's why the paper versus physical narrative keeps returning. It's not a slogan, it's a description of a real structural tension. Paper gold is about exposure. Physical gold is about possession. Exposure can be multiplied. Possession cannot. So how is the dislocation executed when it becomes severe? The mechanism is usually some combination of leverage, margin, and liquidity preference. Imagine a crowded bridge. Everyone is walking, it's fine. Then the wind picks up, the bridge sways, and suddenly people try to move faster. The bridge doesn't widen because people want it to. The constraint is the structure. In markets, that structural constraint is funding and collateral. When volatility rises, margin requirements can rise. When margins rise, leverage positions become heavier to carry. And when positions become heavier, traders sell not because they change their mind, but because the cost of staying becomes unacceptable. At the same time, physical buyers often behave counter-cyclically. When price drops sharply, physical demand can increase because buyers see value or because they distrust the paper shock. That's what happened in 2013. And when price rises sharply, physical demand can remain firm if buyers are motivated by currency hedging, geopolitical uncertainty, or long-term reserve behavior, rather than short-term price sensitivity. In the current setup, you have the potential for 2 different stress events. Stress event 1 is a paper unwind. If the same vehicles that absorbed flows become the path for rapid selling, the price can see sharp drawdowns even if physical demand remains. Stress event 2 is a physical squeeze. If demand for a specific form of deliverable metal rises, while vault inventories are less willing to move, premiums and spreads can widen, and the easy liquidity story breaks. Neither outcome requires a conspiracy. It requires only what markets always contain: mismatched time horizons. Financial investors can change positions in minutes. Physical holders often think in years. Central banks think in decades. When those horizons collide, the market doesn't care about narratives. It cares about who has to act and who can wait. So what does the pattern suggest going forward? Historically, when a market sees large institutional flows into paper exposure while the physical baseline remains strong, the next phase often involves volatility. Not necessarily a crash, not necessarily a straight lineup, but a regime shift. The market starts testing the plumbing. It tests whether liquidity is real across forms or only in the most liquid instruments. There are three broad scenarios that history makes plausible. The conservative scenario is digestion, flows slow, price consolidates, and physical demand remains a stabilizer. In that world, gold behaves like a mature bull market with periods of boredom that shake out late entrants while long-term holders stay anchored. The moderate scenario is oscillation. Paper flows swing, media narratives flip, and price experiences sharp rallies, followed by sharp pullbacks, while physical demand and central bank buying provide a floor. In that world, the volatility is the message. It is the market redistributing ownership from weak hands to stronger hands, and repeatedly testing whether the system still treats gold as a reserve asset. The aggressive scenario is dislocation. A gap opens between paper pricing and physical availability, premiums widen, and the market is forced to reprice the convenience of immediate settlement. In that world, you would see stress signals, unusual spread behavior, persistent premiums in physical products, and a growing focus on where the metal is stored, rather than just what the spot price prints. What should be watched if you want to read the market without guessing? Watch the flow data, whether ETF inflows remain persistent or suddenly reverse. Watch central bank behavior, whether buying remains elevated or softens materially. Watch physical indicators, bar and coin demand, and the signs of tightness that show up as premiums, delays, or unusual regional pricing. Watch volatility and margin conditions in futures markets because those can trigger forced moves even when fundamentals don't change. And watch the narrative shift itself. When experts contradict each other loudly, when one camp says record inflows mean danger, while another says record demand means stability, the contradiction is often a symptom of a market transitioning from one regime to another. The argument isn't the story. The fact that the argument exists is the story. Because the real divide is not between optimists and pessimists. It's between those who track the plumbing and those who track the headlines. It's not about being smarter. It's about paying attention to what changes first. Flows change first. Custody behavior changes first. Funding conditions change first. Headlines arrive last. Information gaps become wealth gaps because they determine timing. Institutions move first because they must manage risk across large books. Retail moves last because narratives arrive late and are often simplified into a single cause. But markets are rarely moved by a single cause. They are moved by constraints, incentives, and the collision of time horizons. So when you hear gold broke the pattern, ask which pattern? The price pattern on a chart or the pattern of trust and settlement beneath it? Gold can rally for years while building structural stress. It can fall sharply while physical demand quietly absorbs. It can look liquid while becoming tighter in the specific forms institutions need. And it can look crowded while still being underowned relative to the size of global financial assets. The question isn't whether the paper and physical stories will converge. They always do eventually. The question is how they converge. Through calm digestion, through violent volatility, or through a repricing of what immediate, unquestioned settlement is worth. This is Signal and Bullion, where we decode what matters before it becomes the headline. The next data print will matter. If this connected dots you hadn't seen connected, you know what to do. Because the question isn't whether this unfolds. The question is whether you recognize the pattern before it does.